Philanthropist Kerry Killinger was the chairman, president, and CEO of Washington Mutual Bank, a chartered financial analyst and a fellow in the Life Management Institute. He was vice chair and chair-elect of the Financial Services Roundtable, vice chair and chair-elect of Federal Reserve's Thrift Industry Advisory Council, and vice chair of the Federal Home Loan Bank of Seattle. He was named American Banker's Banker of the Year. He was chair of the National Education Summit of Achieve and received President George H.W. Bush's Points of Light Award for his philanthropy. Kerry was elected to the American Society of Corporate Executives and is currently CEO of Crescent Capital. Currently CEO of Olympic Consulting, Linda Killinger was vice chair of the Federal Home Loan Bank of Des Moines and chair of its Audit and Finance Committee. She's been a consulting partner in an international accounting firm specializing in strategic planning and financial merger acquisitions. And prior to working as the publisher and editor for Overseas Business Magazine, was appointed by Iowa Governor Robert Ray as the director of administration for that state's Department of Human Services, which included the prison system, mental health hospitals, AFDC, and other human service programs. She was appointed by Governor Tom Vilsack to chair his committee for comprehensive housing. Sorry, I just lost my screen. Comprehensive housing strategy for Iowa. In 2002, Linda and Kerry founded the Kerry and Linda Killinger Foundation, which works on policy reform, social and racial justice, building community, and access to the arts. Veteran journalist Enrique Cerna is the winner of 9 regional Emmys, among numerous other journalistic honors. Prior to retiring from Cascade Public Media's KCTS 9 in 2018, Enrique spent 23 years producing and hosting award-winning documentaries and current affairs programs. He's reported and produced news segments for national PBS and moderated debates at virtually every level of government. In March, he was appointed by Governor Jay Inslee to the Washington State University Board of Regents. It was just announced that Linda and Kerry Killinger's book, Nothing is Too Big to Fail, How the Last Financial Crisis Informs Today, is the winner of a bronze medal from Axiom as Business Book of the Year. Should make for a great discussion tonight. Please join me in welcoming Kerry and Linda Killinger and Enrique Cerna.
Thank you, Ware. We appreciate it very much, and go Cougs. Well, thank you, Killingers, for joining us for this virtual conversation. That's our lives these days. Everything's kind of virtual, but I appreciate you joining us. Let's talk about the book. The book is called Nothing is Too Big to Fail, How the Last Financial Crisis Informs Today. What prompted you to write the book, and why now?
Well, I think when we looked back and we saw so much misinformation that was taking place coming out of the last financial crisis, and frankly, we started to notice that many of the same mistakes that were made then are being made today. So we said, in order to not have to repeat those same mistakes, let's do the best job we possibly can to research everything about the 2008 financial crisis, put it into the context of what was going on in banking and society and all the things going on, and really nail the reasons of why it really happened, so we could learn from them, and then apply that to today. And that's where I put most of my efforts in, was saying, gosh, the government, the Federal Reserve, and others are making the same mistake again. Let's see if we can get out there and warn them a bit, and try to, so we don't have to do that again. And I'll just say before we get further on that Linda did the enormous amount of research around the 2008 financial crisis. She had the access to all of my personal notes, all the correspondence, things that others just haven't seen about what really went on behind the scenes in that period. And she put years of research into it. This book was really her genesis. She worked so hard on it, did a fabulous job. Then I came in primarily to focus on, so what does that mean for the future? And what things can we really learn from that, so that we have a better society in the future?
So Linda, why did you start digging? And what prompted you to start looking at this? Because it basically it's bringing back a lot of a very difficult time for this country, and also people, particularly here in Seattle, and also during the time that Kerry was in charge of Washington Mutual.
Well, during the 1980s and some of the 1990s, I was a partner in an international accounting firm and specializing in strategic planning for banks and thrifts. So during the crisis, when a bank was in crisis, the regulators would call me in to help build a 5-year plan for a thrift or a bank. And so I was kind of in the thick of it, going to California and Texas and Oklahoma, working with these banks. And then I noticed, 20 years later in this crisis, the regulators acted entirely differently than they did before. They're much too eager to close banks quickly. They didn't want to help the banks. And it just seemed like they were, ignoring the community banks, the communities in this country, community banking, in favor of, trying to make bring everything into Wall Street. And so I thought we really needed to investigate more and more about what government was doing behind the scenes here. And that kind of motivated me to document all this.
So let's talk about some of this up front, because this does delve into what happened to Washington Mutual, how the Fed acted during that time, as well as the housing crisis that I guess really was the one thing that sparked all of this, and the housing bubble and the subprime loans. Kerry, there's still a lot of people in the Seattle area have some bad feelings about what happened with Washington Mutual, how it was handled, and toward you. Do you, in writing this book, is it a way to tell your side of the story of what happened and to show that perhaps you don't feel that it was as much as you're to blame for what happened back then?
Well, I think our goal was just to get the facts on the table. I will admit one of the frustrating things that kind of came out of this is that we saw a lot of misinformation that was put out that just was not factually correct about what was going on. And people needed to point fingers at the CEO, and I understand that. That's not the issue. What I really wanted to do is be sure the real numbers got out there so that people could make their own judgments, and they knew exactly what we were up against and all the things that we did that positioned the bank so it should not have been taken over. And we feel very, very strongly that Washington Mutual was inappropriately seized, and we can show you, and we'd love to get into tonight, into what was really happening with our capital, with our loan quality, with the changes in the business model that we had done. And we were very well positioned to come out of it. And we just got caught in a terrible situation and of what we think was unfair and inappropriate seizure, and frankly, violating some of the normal regulatory protocols that took place in that period. So it's really just to get the facts out on that so we can learn from them.
Do you understand, though, that some people say, is this an attempt to repair your image?
Well, look at, I totally understand that. And this is, I'm just saying our primary motivation here is to get that information out so that I can talk to policy leaders, the federal government, the Federal Reserve, and others about the things that were done incorrectly then so we don't make that mistake again. I'm so worried that we're taking this country down a course of which we may end up with a financial crisis that is more severe than what we all experienced in 2008. And nobody should have to live through that again. It was a traumatic, difficult period for millions of people. The government bungled its way in how they did it. The blame for that crisis should be borne by many, many people, including banks, CEOs, but also the Federal Reserve, the government, the rating agencies, the big Wall Street firms. And we just kind of go through how we think each of those parties had some impact on this.
In the book, you write, in the bleak days at the height of the crisis, elected and appointed officials turned finger pointing, cover-ups, and diversionary tactics into a cottage industry. Instead of learning from past mistakes and charting a new, safer course, leaders through overly expansive monetary policies and runaway federal budget deficits now put us on a path toward a new financial crisis. Let's start first with what you are saying in regards to how the Fed, the Federal Reserve, had handled things back then.
Yeah.
Because the housing thing started really, I suppose, early 2000s when things started to build there.
Yeah.
What are you claiming? What are you saying as far as the mistakes that they made that then started this?
Okay, I want you to listen to this one very carefully, because I'm going to circle back to this about what the risks are today. What happened in the early 2000s is the Federal Reserve got very easy on money. They flooded the system with money. They kept interest rates below the rate of inflation. We call that negative real interest rates. And when that happens, that causes asset bubbles, because everybody's got too much money. They go out and start overpaying for things, and they bid up the price of housing to some unrealistic levels. And beginning in about 2003, about 4 years before the crisis really hit, I was on a council with the Federal Reserve, and I went in and told the chairman, told the board, I'm worried housing prices are rising too quickly. They were rising at about 3 times the rate of inflation for a period of time there. And I said, start reining that in, or we're going to end up with a bubble. And they said, don't worry about it. We have the smartest economists in the world. They tell us there's nothing to worry about, and go about doing your thing. And the one thing we did, we took that and we started talking to our shareholders, to the regulators, and I mentioned the Federal Reserve, saying there's a major problem coming. And we decided to change our entire business model. We reduced residential lending by 74% over those ensuing 3 or 4 years. We raised our credit standards every year. Our loan losses were about half of what the industry was. And we went out and raised new capital and became the highest capitalized major bank in the country. So those are all the things we tried to do to get prepared for it. And we thought we were in pretty good position. But then the Federal Reserve made exactly the opposite mistake, which is when the bubble started to look like a problem, they went the other way and just cranked down all the liquidity in the system. They shot interest rates up and they stopped lending to everybody. And guess what? The capital markets totally froze, and that with fewer buyers, then the prices of everything, housing, stock market, any securities, loan portfolios, whatever it might be, just plummeted. And before they knew it, it was out of their control. And then they made the terrible mistake, in our opinion, of letting Lehman Brothers fail. And when Lehman Brothers failed, it caused an entire panic throughout the financial system. And then things just cascaded. And that's where Washington Mutual got caught in that liquidity problem. We had just left, so I wasn't there to see that firsthand. But everything else in the book, we saw it firsthand, and I know what all of our strategies were, and we have all the data to show you to back up the statements I just made.
But hadn't Washington Mutual, under your leadership at that time, changed its focus as well, where they were putting more focus on mortgages, and you made some changes in how you were managing the company as well, and you got into the subprime business as well?
Yeah, I think that was one of the misperceptions we'd like to talk about. The primary strategy we had leading up for several years before the crisis was to reduce residential lending, because I was concerned about the housing market. And instead, we bought a credit card company and grew it very significantly. We became one of the largest multifamily or apartment lenders in the country. We increased our small business lending dramatically, and we also got into some regular commercial lending. So residential lending became a shrinking part of our business. And again, I don't want to bore people too much with the charts, but if we could have chart number 2 pulled up while we're talking, this shows the amount of annual loan originations for Washington Mutual and all the other top banks.
5 regulated banks that
Yeah.
were doing the mortgage.
Let's see if we can get slide number 2 there.
Yeah, we're trying to pull it up now.
Okay.
Just give us a second here. So during this time, do you feel that one of the claims you make in the book is that basically, I think you're just saying, arguing that the Fed was, well, JP Morgan Chase had been chasing Washington Mutual, had been wanting to buy Washington Mutual. And one of the things that you are claiming is that basically that ended up happening, but it also had a lot to do with the fact that the Fed was giving them that opportunity to do that in the long run. Is that what you're claiming?
Yeah, I'll circle back to answer that in just a half.
Yeah, just a second. Okay, I was trying to fill there while they got this up. Go ahead.
While the slide is up, just so people can take a look at, these are all the residential, there it went.
There we go.
Loan originations that were done by the major banks in the country. And if you'll notice that heavy blue chart are the originations of Washington Mutual. And look how we cut that every year. So that idea that we were increasing residential lending leading up to that is just false. We cut them by 74%, and we also reduced our market share in half, while you can see that others were increasing and others did not have anywhere near the kind of decrease that we did.
So those cuts were coming in 2007? About a year?
Every year.
In 2003, Kerry first started being startled by how fast the mortgage market was growing and didn't think it was safe anymore. So you'll notice in 2003, he cut all mortgage lending in half and then continued to cut it. So the total between 2003 and 2007 is down 74%. So by 2007, we were doing substantially less lending, less mortgage lending than any of the other large banks.
So let me go. Okay, thank you. Can we go back to the other question that I raised?
Sure.
And that is that I believe you're saying, and you're claiming in the book, is that Washington Mutual should not have been allowed to collapse or fail, and that in essence, the JP Morgan Chase was able to come in and get a bargain basement price.
Yes, and if you go through the book, it's kind of almost like a Grisham model in chapter 1, because the JP Morgan, according to the bankruptcy examiner who interviewed everybody, they said that JP Morgan had no intention of paying full price for Washington Mutual. When they were doing the capital raise in March of 2008, Chase did not give an $8 bid, and they admitted that to the bankruptcy examiner. What it was is a non-binding indication of interest. And we knew from experience with some of these folks that would be, lowered and lowered, and you'd never get a full price.
So when did JP Morgan Chase come into the picture in all of this? I mean, had they've been trying to buy Washington Mutual as of when?
Well, I think ever since Jamie Dimon became CEO of JP Morgan Chase, he had his eye, he needed to expand the branch operation nationwide because they just were mostly focused on the East Coast. So he knew that the best acquisition he could do was Washington Mutual because it would give him a national footprint and instantly make him probably the biggest bank in the world.
And why, Kerry, were you at that time trying to fight off any acquisition of them, or what was going on there?
No, well, look at, we were always interested in looking at all possibilities for our shareholders, be it making acquisitions, which we did a lot of, but I talked to a lot of people about potentially buying Washington Mutual over the years when we thought that made sense, or merging with another big commercial bank where it made sense for everybody. And so I knew, of course, Jamie, and I know the JP Morgan Chase people very well. What happened when the financial crisis hit, our board said, we need to really focus on getting our capital increased, reducing residential lending even more, which we did, get our cost structure down, and just batten up the hatches and get ready for a difficult period. In the spring of 2008, as the markets continued to deteriorate, we decided we needed to raise substantial additional capital. And we had a ton of investors wanting to give us new capital. But because the stock prices were down at that period, we had to go through the thinking about, is it better for our shareholders to issue new shares and bring in all that new capital, but be diluted, or to be better to do a transaction with another major bank? And certainly banks like Wells Fargo, JP Morgan Chase, several international banks were very interested in the franchise of Washington Mutual. So we said, before we finalize raising this new capital, we at least should check with all the parties and see if there's something better for the shareholders that we should consider right then. And as we went through that process, there was nothing, no one put up a price and an approach that was that the directors felt was good and in the best long-term interest of the shareholders. And we're particularly concerned by, in the case of JP Morgan Chase, they never submitted a formal bid. They just gave kind of an informal indication of interest. And then when we subsequently said, okay, it's time to raise the new capital, we did that. Then they continued to talk to investors and saying that they wanted to find a way to still try to do something with Washington Mutual. And they started talking to the regulators, to Treasury, and to others to express their interest that they would love to somehow get a deal done with Washington Mutual.
So one of the things that, well, you argue in the book is that really the Fed put its support more on Wall Street banks and then on banks such as Washington Mutual, although Washington Mutual had grown so much as well.
Yeah.
So why? What was? Go ahead.
But as I say, we, our primary charter was still as a savings bank, and so so we would be categorized by them as not a Wall Street outfit, but a Main Street bank or a thrift. And one of the other cross currents that hit during that period is then Treasury Secretary Paulson came up with a study and recommendation that the thrift industry be eliminated and be consolidated into Wall Street. So you kind of had three things coming together that really caught Washington Mutual. One was a rapacious appetite on behalf of JP Morgan Chase. The second was Treasury saying, how can I take care of my club members on Wall Street and see if I could find something to merge into them? And then the regulators, who all started to panic when the financial crisis hit, including the FDIC, said, you know what, we can do a transaction and put those two together and not have any cost to the FDIC insurance fund. And they were scared to death at the time that the FDIC insurance fund was going to go under. They had just paid out a huge amount of money for IndyMac when they failed, and I think they were all in kind of a panic mode.
So, Linda, what did you find, I guess, that would back this up?
Well, during the summer of 2008, the bankruptcy examiner discovered that JP Morgan Chase had been working through the entire summer through September, trying to bully the FDIC into seizing Washington Mutual. It was they did not want to pay full price, but they figured out that the seizure was really the best opportunity for them because they didn't have to get a shareholder vote. They could do it quickly. They didn't have to mark all the assets down the market and didn't have to raise as much capital. So it was a kind of a win-win from them to do seizure. But there was a problem. First of all, Washington Mutual in the summer and fall of 2008 was the most highly capitalized bank in America. It had a 10% Tier 1 capital ratio and a 14% adjusted risk capital ratio, which is the highest of all the large banks. The second problem they had was Washington Mutual's loan losses were much lower than the industry. Up to the crisis of 2007, the Washington Mutual's loan losses were 0.5%, much lower than the industry, and they stayed lower than the industry. By 2008, the industry had a 3.3% loan losses in mortgages. Washington Mutual is just slightly above 1%. So that was the second problem. Then liquidity. Washington Mutual had $50 billion of liquidity, which is really just the ability to borrow and up to $50 billion if you had to. So that was right. And so they figured the only thing they could really attack is liquidity. So it was very mysterious in September when they let Lehman Brothers fail. They took over Fannie and Freddie. And then they realized that Goldman and Morgan Stanley might be having a problem. That was about the 20th of September. And so they literally made Goldman and Morgan Stanley bank holding companies, which allowed them to borrow billions and billions of dollars. So they had all the liquidity they needed. And 2 or 3 days later, Treasury and Federal Reserve, and we know this for a fact because we talked to the people at the Federal Home Loan Bank of Seattle and San Francisco. So a couple days after they gave all this money to the investment banks, they called the Federal Home Loan Banks and said, cut off liquidity for Washington Mutual.
So what did you want them to do, or what do you think they could have done that would then have kept Washington Mutual from collapsing?
I think they needed to, they were in pure panic mode. There was no plan at all, just pure panic. And if they were going to open up the doors for all the money in the support for Goldman Sachs and Morgan Stanley, why couldn't they 3 days later give that same liquidity support to Washington Mutual? And then several days after that, why not give it to Wachovia? Why not give the same liquidity to Wachovia as they gave Goldman Sachs?
So why didn't they, I guess? I mean, what was it
because Paulson wanted to consolidate banking into Wall Street, which is what he said in his March 15th blueprint for a new financial system.
Yep.
So, Kerry, are you then saying that both of you arguing that basically Washington Mutual got caught in the crossfire of all of this stuff, and that's what you were allowed to fail?
Yeah, look, again, we've used the word many times that we think it was an inappropriate seizure. My firsthand knowledge and my best knowledge is right up through the start of September, because that's when I left. But I can tell you the day I left, our capital ratios were extraordinarily strong. Liquidity was in great shape. We didn't have a run on deposits or anything like that then. Loan losses were coming in better than our projections, and we're about half of what the industry was. And I was totally confident that the next management into the bank would be fine. I was staying on as a long-term shareholder and thought that it would come back just and do very well in the long run, because we just had a fabulous retail network with 2,500 branches and adding 1 million customers a year at that time. But then what happened, again, I'm a little bit secondhand because I had left, but when Lehman failed, that caused these capital markets all to freeze and this whole liquidity thing to take off again. And then I think everybody just jumped at the opportunity. JP Morgan Chase wanted to get a deal done very badly. The Treasury wanted to get things consolidated into Wall Street. As Linda mentioned, they gave all the benefits to Wall Street banks, made them bank holding companies, gave them billions of additional funds, made them the winners and the superheroes and everything. And they said, hey, here's this little West Coast outfit. They're kind of disposable. Let's not worry about them.
In years later, in 2013, William Isaac, who is the highly respected former chair of the FDIC, did an extensive review of Washington Mutual's financial situation. And what he said is that if he would have been given all of the financial information, the low loan losses, the capital ratios, the liquidity, everything of a bank on a no-name basis, he would have said that bank would be very healthy and in no danger of seizure. In fact, he said that in the history of this country, no bank with the financial ratios and the financial capabilities and the capital ratios and the low loan losses has ever been seized by the federal government.
Looking back before all of this, what would you have done differently, Kerry, to not have gotten in a position? I guess, well, let me step back, because I had always heard that your philosophy was that you wanted Washington Mutual to be, first and foremost, a good bank, a great
Yes.
banking institution. But gradually, the bank started to get big, and it just, then it was like it was on this course to grow large and to become this national force, I suppose. Was that a mistake?
Well, I think the consumer bank, which is the focus of what we were trying to do, be the bank for everyday consumers. You do need to have a certain size to be economy of scale and be efficient and to be a leader. And I said, we were really on that track and in adding about 1 million customers a year. And we had the highest customer satisfaction scores of anybody in banking. We got the JD Power Award virtually every year for best service and things like that. I think those things and that franchise was extraordinarily valuable. As I mentioned earlier, we also diversified into a credit card operation, and that was a very, very good thing for us. And the multifamily lending was very good. And we had a very large mortgage area. But as I showed you earlier, we several years before that said, this is the worrisome, let's reduce it materially, which we did. Now, maybe 74% wasn't enough. I mean, in hindsight, yes, of course, I would have got out of anything we possibly could, but we took more defensive measures than most. And and there were other things. Look, over the long run, it's better to not be concentrated in any asset category. In that case, residential lending. So I wish we had a little more time to diversify our balance sheet even more. I was trying to get our home lending business to be as small a part of the total as we could, but without being able to make too many acquisitions right then, we just couldn't move quite as quickly as I wish we could have.
Diversify. You sound like my broker. Anyway,
Good advice.
Yeah, that's what I hear. Let's talk about where we are right now. Okay, so 2008, we're 13 years later. We obviously are going through this incredible, unusual time where so much is going on with COVID, its impact on the economy, racial reckoning, a middle class that's almost like non-existent. What concerns you about what the federal government is doing right now, or I guess the Federal Reserve, and how it's handling things? Because, obviously there is the stimulus that has come through. People need that. Are you concerned that it's too much?
Yeah, let me put those into two separate categories for a moment. One, the Federal Reserve, and then secondly, the federal government. We really need to talk about both of them because they're slightly different topics. In the case of the Federal Reserve, and this is the one I'm perhaps more concerned than anything else, the Federal Reserve really helped cause the last financial crisis, as I mentioned, because they panicked, closed off liquidity, and before they knew it, the system was in the tank. And they had to respond to that with massive new liquidity. So they flooded the system with money supply. They lowered interest rates to near zero. They started buying and guaranteeing securities and things. And all those measures helped stabilize the stock market and housing market and the economy. And we applaud them for it. That was the right medicine at the time. But these guys got hooked on that medicine of easy money. And so here we are, 13, 14, 15 years later, and even after the economy had stabilized, let's talk pre-COVID for a minute, we were still flooding the system with excess money, super low interest rates, way below the rate of inflation. Remember before the last housing crisis, when that housing bubble was growing, one of the key reasons is they had interest rates lower than the rate of inflation. And sure enough, people took all that money, started pumping it into stocks and housing and so forth. Well, that's getting done on a supersized scale today. We are seeing asset bubbles grow all over. Some call this the bubble of everything. And whereas in 2008, it was the breaking of a single bubble, today we have stock prices at not only record levels, but in relation to earnings, in relation to the GDP of the country, is at prices unprecedented in our history. And some of that is because there's too much money chasing a limited number of assets. Same thing, and all of us see it in housing. Every community that we know of is having a housing boom right now, where housing prices are up nationally about 11% in the last 12 months, while inflation is about 2%. So that's crazy. Again, we're seeing the speculation in housing growing dramatically. Many markets, including Seattle, growing much faster than the national average. And that is being caused because the Fed has interest rates so low, it makes housing very affordable because interest rates are artificially low. My question is going to be, is if that is a bubble right now, what happens when the Fed has to start increasing interest rates and those mortgage rates rise fairly significantly? And the affordability of housing then with higher interest rates causes fewer and fewer buyers. And if we don't handle that very carefully, we could end up in another situation where housing prices go through a difficult period. But even beyond stocks and housing, just look what's going on in Bitcoin. Look what's going on in GameStop stock. Look what's going on in these new digital art things. Look what's happening to the top works of art in the world. They are all escalating into bubble status, and speculation is running rampant. In the stock market today, we are now record levels of margin debt. And so people are out buying stocks, getting the hot ones, getting the SPAC, getting whatever the new acronyms we might have for some new products, and they're leveraging to do that. And so these are all speculative conditions, and our worry is that the Federal Reserve has to find a way to gradually unwind that bubble. Or if they just keep using the same medicine of pouring money and giving everybody freebies, guess what? That bubble could break at any time. And if you have multiple bubbles break at the same time and the government's not prepared for it, we could end up with a problem that's even greater than what we saw in 2008.
Well, let me ask you about the stimulus that that the president and that Congress passed barely. Was the amount of that, do you think, an appropriate amount? Too much? Too little?
Well, I'm going to use the same analogy that sometimes medicines are really good. And to get out of a recession like we did in 2008, you've got to go to deficit spending, and that works good. The government can really help stimulate its way out. But then we got hooked on it again. And so we kept huge budget deficits right up through leading into COVID-19. We were running $1 trillion a year budget deficit. I know trillions, we all kind of glaze our eyes on, but that's a lot of money. And now look we have to deal with COVID, and we're totally supportive of that. But in our opinion, it should be very focused on those that really got hurt, those needing it, unemployed, and so forth. But our stimulus packages have been pretty broad, very popular, because the majority of people got checks.
I'm sorry, but I'm curious about one thing. So as we know that our deficit is growing, and obviously with COVID and what's happening now is something that it's needed just to help people and the economy. But there was also a big tax cut during Donald Trump's presidency. Yeah. Was that needed? Because, wasn't that just adding to the deficit that we didn't need?
Yeah, I'll probably have everybody on the left and everybody on the right mad at me because we try to be rational in the middle. Look, I don't think that breadth of tax cuts was necessary and appropriate for the long term. I think it just added to our budget deficit. And I think we have some very necessary things we need to spend money on, and we've got to build infrastructure. We got to get our healthcare systems down. Got to take care of Social Security. We had a lot of things we have to do. But you can't do that when you're already at $1 trillion deficit. And then you're going to go up to 2 to 3 trillion a year to get us through the COVID thing. And now we're going to layer on another 2 or 3 or whatever the trillion might be for infrastructure build. And there has to be a balance between getting spending and getting the revenues in sync, and they're not. So yes, taxes have got to find a way to move up some, and spending's got a way to get down. And I don't want to be the one trying to say exactly how you're going to do that, but I think the politicians have got to be held accountable to somehow get that absolute level of budget deficit under control.
You mean you can't keep printing money forever?
No, well, some think. I mean, there's a theory right now that some have, which I do not subscribe to long term, which said, what's the problem, man? All we're going to do, we're going to incur huge budget deficits. We're going to have the Federal Reserve create money out of thin air, which they do. And we're going to have them go out and buy all the debt that we're originating. And I don't know, I'm my humble Iowa roots, that sounds like a Ponzi scheme to me. And so over the long run, I don't think you can do that forever. I mean, our families, how'd you like to be able to do that? I mean, that's just not prudent long term.
And we're really concerned because the system of inequality, income inequality in this country is the worst it's been since right before the 1929 crash. There are that many people that are vulnerable. And so any other kind of bubble bursting or anything like this it's going to have a dramatic impact on the average American and their ability to maintain the middle class life.
You know, said another way, that's a great point, is that these bubbles that are going up are primarily benefiting the top 10% of the households in our country. The bottom 50 or 60 or 70% are not benefiting because they're not big investors in the stock market, whatever. It's concentrated into the top people. So when bubbles grow, the people that benefit the most are the top 10%. But when bubbles break, and they inevitably do because nothing can go up forever, guys. And when they do break, it doesn't hurt that top 10% nearly as much as it hurts the bottom 50, 60, 70%, because they're the ones going to lose jobs. They're the ones already going paycheck to paycheck. And our tax policies in this country have also fostered real big advantages for people in the upper income brackets and people getting all their gains through capital gains, and has penalized those working paycheck to paycheck and those working basically for wages. So I think the country needs to deal with that, with the idea of how can we bring back a strong middle class.
Let me move to some questions here that we've received. If the decision, this is a question that we have received from one of those participants tonight. If the decision to bolster Goldman and Morgan Stanley was a move to protect institutional and wealthy investors over retail-oriented banks like WAMU and Wachovia and ordinary Americans, do you think this, I kind of lost track here. Do you think this could be driven by the access investment bank clients have to elected officials and government decision makers?
Don't get me started. The National Bureau of Economic Research studied this issue really carefully. And they basically said that there's a direct link between the banks in Wall Street who put the most money back into Congress and lobbying were the ones that got the most money back in TARP. And what the NBER recommended was that
what is the MBER? I'm sorry.
The National Bureau of Economic Research. What they recommended is that the government watchdogs have got to be watching the lobbying money that's going into Congress every year. Because there's a direct link.
Well, we used a phrase in a congressional hearing once that got me into a little bit of trouble, but I referred to what really happened is Washington Mutual was not, too clubby to fail. And that there was an interaction going on between the major Wall Street firms, with the regulators, with Treasury, and it's kind of an incestuous in and out and relationships in this. And when the decisions were made about which banks were going to be saved, which were going to be thrown under the bus, which one do they like, who do they want to give the special favors to, it was all part of that inner club. And I think for the country, that's a dangerous thing to have happen. I think democracy says, no, this ought to be spread out a little bit. I think there ought to be political finance reform. There ought to be restrictions on how fast people can move in and out of regulatory and government and private industry jobs, or you just end up with a system that that makes poor decisions, in our opinion.
And Washington Mutual didn't spend a lot, billions and billions in lobbying Congress. They didn't think they had to. It was a long time 2-rated bank the whole time Kerry was CEO. The bank had never had a formal enforcement order. The bank had never had, or any of the executives had never had fines or penalties of any kind. So Kerry thought the system was working. You could be an honest bank, not have to bribe Congress, and come up with good numbers, and maybe you'd be okay.
Yeah.
Another question here. Did Chase retain any WAMU employees, management and/or non-management after the takeover?
This is pure irony. The only top executive that they kept was the head of the residential home lending.
No, that actually, well, he was there. No, let me broaden it out a little bit. Again, Washington Mutual had some fabulous employees. I mean, I think I'm very biased, but I think we had the best employees in the business. And fortunately, most of the employees or the majority in our branching system were able to stay on with JP Morgan Chase. And I'm sure they did a great job for them. And I just wish them all well. I think in terms of some of the senior managers, there were actually a few that went there. Some have stayed, some have not. I think I mentioned we have an outstanding a multifamily lending business, and the leader of our business on that leads it for all of JP Morgan Chase now. So again, I think they're just fabulous people. I wish nobody had to go through what our employees had to go through, but I know also most landed well because they were so capable.
Yeah, one of the things that's been in this whole experience lately of releasing the book is that we have had so many Washington Mutual employees get in touch with us and say, thank you for doing this book. We really wanted to get the truth. We want to finally have a book with all the true facts about what really happened at Washington Mutual. And we really appreciate them contacting us about that.
One of the questions that was posed here is that why was it important for you for Washington Mutual to become the largest bank?
Yeah,
that was never the goal.
It would never.
Again, it comes back to what
Yeah.
I mentioned
Thank
before
you.
is that you had, I think, for the longest time, you talked about Washington Mutual being, and it gained a lot of traction actually, a good bank, for the people, a good bank, and it was a thrift bank, well known.
Yeah.
I was a Washington Mutual. I had a bank account there. They owned my house at one time, but again, as things changed and the bank grew, and that's where that question comes from. And why was that so important?
It's interesting because in order to survive in the 1990s, there was a huge banking consolidations. All the banks went through huge consolidations. So if Washington Mutual wouldn't have grown or purchased other banks, they would have been acquired. Mm-hmm. It's just the people that survived to the year 2000 were the ones that went through huge consolidations. JP Morgan Chase, Citigroup, look at all the building they did. And Bank of America and Wells Fargo, they all did the same thing. And that's how they got to one of the biggest banks in 2000.
But I would say, again, we never had a goal of being the biggest. Consistently in our mission statement, it was how do we become the premier? We just wanted to become the best. And we had a balanced scorecard that said we're going to measure ourselves on not only our earnings, but how many customers, customer satisfaction, employee engagement, return on our capital, low levels of non-performing assets and the like. And that's how we paid all the managers too, or at least the top managers. There was never a goal or anything out there saying we're going to get to some gigantic size.
And actually, they got big with 2 acquisitions, and those were 2 companies, 2 thrifts in California, along with the regulators who actually came to Washington Mutual and said, "Please buy us." So it wasn't that he was out trying to get the bigger thrifts; they came to him.
We got about 5 minutes left. A couple of questions I'd like to ask regarding today in the current economy. What would you tell people about how to go about protecting themselves in this time? because
Yeah.
it is so unpredictable right now in so many different ways. And we're not just talking about how you make a living on a daily basis, but just life in general. But from a financial standpoint, to be able to protect your family, what advice would you give?
Well, Enrique, thank you. I think that's a great question. And I think this is a period, we'll come back to, we mentioned earlier, diversification is a really good thing because I would not want to be putting all my eggs in one basket that's speculative, happens to be the hot stock of the day or some kind of a trend. I stay very, very diversified. The second is I think everybody, depending on their age, their goals, should have a kind of a range of how much they're going to have in cash, how much they're going to have in bonds, how much they're going to have in stocks, how much in real estate. And then you manage those within a range of those about either emphasizing or de-emphasizing certain areas. The areas I would de-emphasize just a bit right now are things like common stocks, because again, all-time record. I think I'm just a little worried that some of the more speculative issues may be vulnerable to some type of a correction. Going on the other side, taking advantage of low interest rates to lock in your mortgage on your house for 30 years, that's a pretty good time to do it. I would.
I just did that.
Yeah. I think that's the really smart move.
Yeah.
I don't think the smart move is on the other side, which is I want to lend Enrique 30 years at 3%. I mean, when inflation's only going to be 2%, I mean, or 2 or 3%. That doesn't.
Yeah, but it works for me. So
it works great for the borrower. So take advantage of it.
One thing that we only have a few minutes here left, but I didn't get into too much because we started talking about other things. But in the book, you write a lot about shadow banks. You write about the impact, which really had a lot to do with the subprime cause, the crisis that then built and all of that. Has enough been done to make sure that those types of banks are not around anymore, or making sure that they're not going to be posing another issue? And in the past administration, was there efforts to loosen the regulations that could create some fear now?
That's a really good point. I'm glad you brought that up. One of the pieces of original research that we did on the book is get an accurate count on who was doing subprime lending and who was doing the worst of the subprime lending. What we discovered is that there was a handful of shadow, unregulated banks, AmeriQuest and Century, Franklin, probably names people have never heard, that were literally producing 85% of all the subprime loans. The regulated banks like Washington Mutual and JP Chase and Citigroup were only producing 15% of the subprime loans. And the unregulated shadow banks they performed 2 or 3 times worse than what the regulated banks performed at. And so they fed all of their $2 trillion worth of subprime loans in a 5-year period. They did $2 trillion worth. They fed it right into Wall Street. Wall Street then put them into all the CDOs, the collateralized debt obligations, insured by $62 trillion of the credit default swaps. And that really was what I think most economists have said now was really caused the crisis, was this crush of CDOs that made banks very vulnerable. Washington Mutual did not do any CDOs. Now, what's happening now is that most mortgages now are made by shadow banks that are not regulated. The difference this time is that all the shadow banks that are originating all the mortgage loans, all the auto loans, all the personal loans, there's a ton of online companies that are doing that. They're feeding all their loans into Fannie and Freddie to be securitized. And Fannie and Freddie right now have pretty good standards, so the system is working. But the minute these online companies or unregulated companies figure out how to securitize their own loans, or work with hedge funds or other places to securitize their own loans and lower standards, then we're kind of in the same place we are.
Then they
we
get
were
greedy.
before.
You're saying they get
Yeah.
greedy.
Absolutely.
Yeah. And but are the regulations, were the regulations to regulate the industry so after the big recession, are they still as tight as they should be?
Yeah. So I think, first of all, the regulation for the banks that are regulated, I think is very strong right now, and the banking industry is in excellent position. I'm worried about these bubbles breaking. I think we could be headed for some real difficult times, but I think the regulated bank industry is in a good position right now. I'm more concerned about the shadow banks. Once again, they are about twice the size of the regulated banks, and they don't have much, and growing fast, and they don't have much regulation. And we have I just noticed today that Janet Yellen, Treasury Secretary, was put in charge of revitalizing an oversight council that was set up in legislation following the 2008 crisis to watch out for these risks that are growing. And I think that's absolutely necessary, because we saw in the last time that the regulators missed it. They didn't know about this 85% being done. They didn't know the intertwinings of Wall Street and CDOs and CLOs and CDSs and stuff that
they were unregulated.
Yeah.
And so nobody tracked
and before they knew it, it blew up on them.
Alphabet soup there.
Yeah.
All right. Let me mention, Weir has joined us. He's giving me the hook. The book is called Nothing is Too Big to Fail. And you can pick it up. It's Amazon and all Barnes Noble, all the other places have that out right now. Kerry Killinger, and also thank you very much, husband and wife, for joining us. Appreciate it very much.
Okay,
thank you so much, Enrique.
Kerry and Linda. I'm sorry, I forgot to mention Linda.
I only came back to shill so you wouldn't have to, Enrique, just to hit the book that one last time.
Oh, okay.
And,
you can show again.
Well, while we love Amazon and Barnes and Noble, as I said, please, I urge you to make your book purchase tonight from our friends at Elliott Bay Book Company. That link is in the,
forget what I said there.
No, but listen to every other thing that he said. Just forget that last little part.
Right, yeah. Okay,
Enrique, thank you so much for this. Carrie, Linda, it was
pleasure.
great having you. And thanks for the perspective you brought to 2008 and to the present. We really appreciate it.
Thanks, Weir.
And
Thanks,
for
Enrique.
being a part of our event tonight. We will see you again soon on Town Hall. Thank you very much.
Good.
Thank
Take
you.
care, everyone.
Bye-bye.
Good night, everybody.
Bye.